The potential for deflation to create a liquidity trap. Deflation, the persistent decrease in the general price level of goods and services, can lead to a dangerous economic condition known as a liquidity trap. This occurs when interest rates are so low that monetary policy becomes ineffective in stimulating the economy. Understanding this phenomenon is crucial for economists, policymakers, and investors alike. Understanding liquidity traps. A liquidity trap occurs when interest rates are close to zero, and people hoard cash instead of spending or investing it, rendering monetary policy tools ineffective. This situation can arise during periods of deflation, where the expectation of falling prices further discourages spending and investment. Causes and consequences. Causes: deflationary expectations. When consumers and businesses expect prices to continue falling, they delay purchases and investments, anticipating lower prices in the future. Zero lower bound. Central banks typically lower interest rates to stimulate borrowing and spending. However, when rates are near zero, further reductions become impossible, limiting the central bank's ability to stimulate the economy. Consequences: economic stagnation. With low demand, businesses cut back on production and investment, leading to higher unemployment and further economic decline. Debt deflation. The real value of debt increases in a deflationary environment, making it harder for borrowers to repay, which can lead to increased defaults and financial instability. Historical examples: Japan's lost decade in the 1990s is a classic example of a liquidity trap. Despite near-zero interest rates, the Japanese economy experienced prolonged stagnation, as monetary policy failed to revive economic activity. Policy responses: fiscal policy. Increased government spending and tax cuts can stimulate demand directly, bypassing the ineffectiveness of monetary policy. Quantitative easing. QE central banks purchase financial assets to increase the money supply and encourage lending and investment. Negative interest rates. Some central banks have adopted negative interest rates to incentivize banks to lend rather than hoard reserves. FAQ: What is a liquidity trap? A liquidity trap is a situation where low or zero interest rates fail to stimulate economic activity, often occurring during deflationary periods. Why do low interest rates become ineffective in a liquidity trap? Low interest rates become ineffective because people prefer to hold cash rather than spend or invest, anticipating further declines in prices. How does deflation contribute to a liquidity trap? Deflation contributes by creating expectations of falling prices, which discourages spending and investment, leading to economic stagnation and ineffective monetary policy. What can policymakers do to combat a liquidity trap? Policymakers can use fiscal policy measures, such as increased government spending and tax cuts, as well as unconventional monetary policies like quantitative easing and negative interest rates. Can a liquidity trap be avoided? Avoiding a liquidity trap requires proactive measures to prevent deflation and ensure that monetary policy remains effective, including maintaining moderate inflation targets and employing timely fiscal interventions. Understanding the dynamics of deflation and liquidity traps is essential for navigating economic challenges and implementing effective policy measures to stimulate growth and stability.